Question 1. Which DeFi mechanism helps mitigate the risk of impermanent loss when providing liquidity to an AMM like Uniswap v3? A. Deploying order book systems on Layer 2. B. Using flash loans to balance LP exposure. C. Only supplying single-sided liquidity to yield farms. D. Concentrated liquidity provisioning based on anticipated price range. Correct answer: D. Concentrated liquidity provisioning based on anticipated price range. Explanation: impermanent loss occurs when the price of tokens diverges after being deposited into an AMM, automated market maker, liquidity pool, affecting the LP's, liquidity providers, final balance when withdrawn. Uniswap v3 introduced a novel concept, concentrated liquidity, allowing LPs to allocate capital within specific price bands where they expect the most trading activity. This drastically improves capital efficiency while simultaneously reducing unnecessary exposure to volatile price ranges. This design is detailed in the Uniswap v3 core white paper and has been recognized in DeFi literature as a substantial evolution in AMM design. Question 2. What is the primary difference between over-collateralized DeFi lending and traditional bank loans? A. Traditional loans use algorithmic rates while DeFi uses fixed rates. B. DeFi lending requires collateral that exceeds the loan value due to lack of identity verification. C. DeFi loans offer longer repayment terms than banks. D. DeFi lending doesn't allow for collateral liquidation. Correct answer: B. DeFi lending requires collateral that exceeds the loan value due to lack of identity verification. Explanation: DeFi protocols like AAV and Compound require over-collateralization because there's no credit scoring. If the loan value exceeds collateral, there's no recourse. Question 3. Which Oracle-related vulnerability can lead to underpriced collateral and forced liquidations in DeFi lending? A. Oracle manipulation due to low liquidity on reference markets. B. Incorrect block timestamping by validators. C. Incorrect token metadata in ERC20 contracts. D. Use of zero-knowledge proofs in price feeds. Correct answer: A. Oracle manipulation due to low liquidity on reference markets. Explanation: low liquidity oracles can be manipulated to alter asset prices, leading to wrongful liquidations. Protocols use TWAPs to mitigate this. Question 4. In the context of decentralized exchanges (DEXs), what is the primary cause of impermanent loss for liquidity providers? A. Price divergence between the assets in the liquidity pool compared to holding them individually. B. Sudden increase in trading volume on centralized exchanges. C. Oracle delays in pricing feed updates. D. Excessive gas fees during trading activity. Correct answer: A. Price divergence between the assets in the liquidity pool compared to holding them individually. Explanation: impermanent loss occurs when the relative price of tokens in an AMM changes after they are deposited, causing the liquidity provider to have less total value when withdrawn. This is not due to gas fees or external trading, but price divergence within the pool. AMMs like Uniswap inherently expose LPs to this risk, as the pool maintains a constant product formula, X * Y = K. Question 5. Which design element of algorithmic stablecoins poses the highest systemic risk in a bear market scenario? A. Reliance on reflexive mintan burn mechanisms to maintain the peg. B. High frequency of governance token rewards. C. Collateralization with volatile crypto assets. D. Use of oracles to adjust peg thresholds. Correct answer: A. Reliance on reflexive mintan burn mechanisms to maintain the peg. Explanation: Algorithmic stablecoins like Terra USD relied on mint-and-burn mechanisms involving governance tokens. When confidence drops and the price depegs, the system enters a death spiral as users redeem rapidly, crashing the governance token and eliminating stability. This reflexive dynamic was a key failure point in USD's collapse. Question 6. Jessica is an active liquidity provider on a DeFi protocol like SushiSwap. She notices that her liquidity position has suffered significant impermanent loss due to rapid price swings in a volatile pair. Which strategy would best allow her to maintain exposure without continually incurring impermanent loss? A. Increase her position size to offset the losses through scale. B. Use flash loans to arbitrage her own liquidity position. C. Exit her position and invest directly in Layer 1 staking. D. Move to a stablecoin pool with low volatility assets. Correct answer. D. Move to a stablecoin pool with low volatility assets. Explanation. Stablecoin pools, like USDC DAI, have minimal price divergence, reducing impermanent loss significantly. Liquidity providers seeking predictable returns prefer these pools. Flash loans don't mitigate impermanent loss, and increasing position size amplifies risk. Staking offers yield but shifts exposure completely. Question 7. In DeFi lending protocols like AAV and Compound, how is the loan-to-value (LTV) ratio used to manage collateral risks? A. It sets the interest rate for all users borrowing the same asset. B. It defines the liquidity mining rewards allocated per block. C. It represents the staking requirement for governance voting. D. It determines how much a user can borrow relative to the collateral they deposit. Correct answer. D. It determines how much a user can borrow relative to the collateral they deposit. Explanation. The LTV ratio defines the borrowing power of a user based on the value of their deposited collateral. For example, an LTV of 75% means that if you deposit $1,000 in collateral, you may borrow up to $750 worth of another asset. This mechanism ensures that if prices fall, the protocol can liquidate collateral to cover the loan, protecting lenders and maintaining solvency. Question 8. Which method is most commonly used in DeFi aggregators like 1inch and Matcha to reduce slippage for users? A. Increasing gas price to prioritize the transaction. B. Using off-chain limit orders stored in IPFS. C. Token burning before swap execution. D. Splitting orders across multiple DEXs based on routing algorithms. Correct answer. D. Splitting orders across multiple DEXs based on routing algorithms. Explanation. DeFi aggregators employ smart routing strategies to split large orders into smaller parts executed across different decentralized exchanges' DEXs. This minimizes slippage by accessing deeper liquidity and better pricing. 1inch's Pathfinder algorithm is a prime example. Gas price does not influence slippage, and IPFS stored orders are not typical in this context. Question 9. Mr. Arjun is managing the treasury of a DAO that uses a dual token system. The DAO has suffered from volatility in its native token, which serves both governance and incentive purposes. To improve protocol sustainability, what should Mr. Arjun propose in the next governance vote? A. Switch entirely to fiat collateralized stablecoins for governance. B. Increase token emissions to dilute volatility effects. C. Eliminate staking to reduce treasury outflows. D. Separate governance and utility functions by introducing a stable utility token. Correct answer. D. Separate governance and utility functions by introducing a stable utility token. Explanation. Mixing governance and utility in a single token can lead to unpredictable voting behaviors and unstable incentive structures. By separating these roles, protocols can ensure governance remains in the hands of committed users, while incentives remain attractive and stable. This approach improves governance integrity and financial sustainability, as seen in Curve's use of VCRV. Question 10. What risk does a flash loan exploit typically capitalize on invulnerable DeFi protocols? A. Inadequate gas fee prioritization. B. Improper pricing mechanisms or lack of Oracle protection. C. Illiquid collateral reserves in governance vaults. D. Off-chain signature verification delays. Correct answer: B. Improper pricing mechanisms or lack of Oracle protection. Explanation: Flash loans allow an attacker to borrow large amounts of funds with no upfront capital, as long as the loan is repaid in the same block. Exploits often occur when a DeFi protocol doesn't use secure oracles, like Chainlink, or fails to protect against price manipulation during loan execution. Attackers manipulate asset prices, often in low liquidity pools, take advantage of inflated or deflated collateral values, and extract profits before repaying the loan in the same transaction. Question 11. Which of the following best explains the concept of liquidity mining in DeFi protocols? A. Staking governance tokens for validator rewards. B. Providing liquidity in exchange for additional protocol token rewards. C. Trading high-volume assets with MEV-extracted profits. D. Executing arbitrage across centralized exchanges and DEXs. Correct answer: B. Providing liquidity in exchange for additional protocol token rewards. Explanation: Liquidity mining is an incentive mechanism where users who provide liquidity to a DeFi protocol are rewarded with additional tokens, often the native governance token. This mechanism bootstraps liquidity early in a protocol's lifecycle and aligns community incentives. It differs from pure staking or validator participation, and it's not the same as arbitrage or MEV activities. Question 12. Ms. Carla recently started participating in a DeFi yield farming protocol. She notices unusually high annual percentage yields, APYs, advertised on a newly launched token farm. However, after 2 days, the token's value crashes, and her rewards become nearly worthless. Which of the following risks best explains this event? A. Oracle failure due to invalid data feeds. B. Impermanent loss from volatile asset pairings. C. Inflationary token emissions leading to unsustainable yield. D. Gas fee surges reducing net returns. Correct answer: C. Inflationary token emissions leading to unsustainable yield. Explanation: Many yield farming protocols offer very high APYs by printing large amounts of native tokens. These emissions are unsustainable unless balanced with real value accrual. Without demand or buybacks, token prices crash as users sell off their farming rewards. Carla's experience reflects an inflationary emissions issue, which is a common pitfall in poorly designed farming protocols. This is why mature DeFi projects emphasize sustainable emissions and treasury-backed incentive structures. Question 13. What is the most likely reason a liquidity provider, LP, would experience a net loss despite earning high APY rewards from a DeFi protocol? A. Validators fail to include their transactions on-chain. B. Front-running by arbitrage bots causing reward slippage. C. Impermanent loss exceeding the yield from farming incentives. D. Failure to sign transactions with gas-efficient wallets. Correct answer: C. Impermanent loss exceeding the yield from farming incentives. Explanation: Even when high APYs are offered, LPs can suffer impermanent loss if the price of tokens in the pool diverges significantly. This loss can outweigh the value of farming rewards. High APY is not a guaranteed net profit if market volatility erodes principal value. This risk is well documented in volatile LP pairs like ETH-ALT or BTC-DEF tokens. Proper risk analysis includes comparing farming yield against expected impermanent loss. Question 14. Which DeFi primitive allows for the creation and trading of on-chain synthetic assets, representing off-chain real-world assets, RWAs? A. Liquidity pools. B. Flash loans. C. Synthetic derivatives protocols like Synthetix or UMA. D. Validator staking. Correct answer. C. Synthetic derivatives protocols like Synthetix or UMA. Explanation. Synthetics in DeFi are tokenized derivatives that mirror the value of real-world assets such as stocks, commodities, or currencies. Platforms like Synthetix and UMA use Oracle data and collateral-backed models to issue and trade these synthetic tokens. Unlike liquidity pools or staking, synthetics are designed for asset exposure without holding the underlying. This is a foundational element for DeFi expansion into TradFi markets. Question 15. Mr. Felix is a governance token holder in a DeFi protocol. A new proposal is up for vote to increase emission rewards to liquidity providers. Felix notices that a few large wallets are consistently passing self-serving proposals due to their large token holdings. What protocol improvement would best reduce this governance centralization risk? A. Introduce zero-knowledge proof, voting to ensure anonymity. B. Transition to proof-of-authority consensus for better delegation. C. Implement quadratic voting to reduce whale influence. D. Increase token emission to attract more small holders. Correct answer. C. Implement quadratic voting to reduce whale influence. Explanation. Quadratic voting assigns voting power based on the square root of the number of tokens staked, rather than linearly. This prevents whales from having disproportionate influence and promotes more democratic decision-making. In Felix's case, this model would prevent large token holders from easily passing biased proposals. This concept is increasingly discussed in DAO governance models and is supported by platforms like Gitcoin and Optimism's governance system. Question 16. Which feature of wrap tokens, e.g., WBTC on Ethereum, enables them to function effectively across different DeFi ecosystems? A. Their use of zk-SNARK for private computation. B. Their collateralization by NFTs held on-chain. C. Their one pegging to the underlying asset and custodial backing. D. Their issuance via proof of burn from centralized exchanges. Correct answer. C. Their one pegging to the underlying asset and custodial backing. Explanation. Wrap tokens are tokenized versions of non-native assets, like Bitcoin on Ethereum, that retain value parity with the underlying asset through custodial or smart contract-based backing. For example, WBTC is backed one by BTC held by a custodian. This design allows Bitcoin holders to interact with DeFi ecosystems, e.g., lending, trading on Ethereum or other smart contract-compatible chains without compromising asset value. This is essential for cross-chain DeFi composability. Question 17. Which factor most directly contributes to slippage in an automated market maker, AMM, like Uniswap v2 during a large token swap? A. Price volatility on centralized exchanges. B. High gas prices during block congestion. C. Shallow liquidity and the constant product formula. D. Use of Layer 2 scaling solutions like Optimism. Correct answer. C. Shallow liquidity and the constant product formula. Explanation. Slippage in AMMs is primarily caused by the constant product formula, XY equals K, used to maintain price balance between tokens. When a user submits a large trade relative to the pool size, they cause a significant price movement. This is particularly severe in pools with low liquidity, leading to poor execution prices. Deep liquidity pools help minimize this effect, which is why aggregators often route through several pools. Question 18. Ms. Tasha, a DeFi strategist, wants to design a vault on Yearn Finance that automatically shifts funds between different yield strategies. However, she's concerned about gas costs eroding returns for small depositors. What mechanism can she use to efficiently manage gas and optimize yields? A. Use a centralized RPC node to bundle user transactions. B. Implement auto-compounding strategies with frequent harvesting. C. Aggregate deposits and rebalance using batch transactions. D. Require each depositor to manually restake every 12 hours. Correct answer. C. Aggregate deposits and rebalance using batch transactions. Explanation. In vaults like Yearn, gas efficiency is critical for net yield. By batching transactions and rebalancing the entire vault rather than processing each deposit individually, gas usage is amortized across many users. Vaults often use strategists or keepers to handle periodic strategy reallocation, further improving efficiency. Auto-compounding too frequently can actually waste gas and reduce returns, particularly for smaller positions. Question 19. What is the main reason that overcollateralization is required in most DeFi lending protocols? A. To improve blockchain throughput and reduce latency. B. To comply with AML/KYC regulations. C. To mitigate the lack of trust and ensure solvency in permissionless environments. D. To incentivize node validators to confirm borrowing transactions. Correct answer. C. To mitigate the lack of trust and ensure solvency in permissionless environments. Explanation. DeFi lending protocols like AAV, MakerDAO, and Compound operate without intermediaries or identity checks. Because loans are permissionless and trustless, they require users to post collateral greater than the loan amount to ensure solvency. This protects the protocol and other users in case of price drops in the collateral. It's a core trade-off of trustless lending, compensating for the lack of credit scoring or legal recourse. Question 20. What is a key vulnerability that often arises from DeFi protocols relying on time-weighted average price, TWAP, oracles without proper safeguards? A. Front-running by Layer 1 miners. B. Flash loan-based manipulation of spot prices within short time windows. C. Delayed execution of staking rewards. D. Infinite token minting due to missing rebase triggers. Correct answer. B. Flash loan-based manipulation of spot prices within short time windows. Explanation. TWAP oracles average token prices over time to avoid reliance on a single block's price. However, attackers can still manipulate these prices briefly using flash loans, borrowing large sums in one block, altering the price in a low-liquidity pool, then repaying within the same transaction. If a protocol depends on this manipulated price for collateral valuation or synthetic issuance, it becomes vulnerable to exploits. This risk highlights the need for secure external oracles, like Chainlink, and price update frequency limits. Question 21. Mr. Jamal is considering participating in a newly launched DAO that manages a DeFi insurance protocol. The governance token allows voting on claim approvals, reserve allocation, and premium structures. However, a few large holders are trying to rush through proposals benefiting their own risk pools. What governance improvement could Jamal propose to prevent short-term exploitation and ensure community fairness? A. Set up fast-track voting where whales can immediately pass proposals. B. Require Know Your Customer, KYC, verification for all token holders. C. Introduce a time lock and quorum mechanism for proposal execution. D. Allow anonymous voting through off-chain Discord polls. Correct answer. C. Introduce a time lock and quorum mechanism for proposal execution. Explanation. In DAO governance, especially involving DeFi insurance and treasury decisions. It's crucial to prevent governance capture and rushed malicious proposals. Time locks ensure that even after a vote passes, there is a cooling-off period before execution. This gives the community time to audit, challenge, or fork if necessary. Quorum thresholds ensure that proposals must have sufficient participation to be valid, reducing the influence of a small group of large holders. Platforms like Compound and Aragon implement these governance guardrails. Question 22. Why do some DeFi protocols adopt dual token models, with one token for utility and another for governance? A. To create artificial scarcity in governance markets. B. To comply with Ethereum's ERC 777 standards. C. To separate volatile incentives from long-term governance rights. D. To force liquidity migration across Layer 2 chains. Correct answer: C. To separate volatile incentives from long-term governance rights. Explanation: dual token models are used to segregate incentive volatility from governance influence. A common approach is to have a utility token that users receive as rewards, which may have high supply and price fluctuations, and a second, governance-focused token with voting rights often locked or staked, e.g., VCRV or XSUSHI. This model promotes long-term protocol alignment, reduces governance manipulation, and mitigates the dilution of voting power caused by short-term yield farmers. Question 23. What risk arises when DeFi insurance protocols allow open claims voting without sufficient claim validation mechanisms? A. Increased validator slashing across the Ethereum network. B. Governance token deflation and unclaimed emissions. C. False claims being approved due to bribery or uninformed voting. D. Fragmentation of Layer 2 liquidity pools across insurance vaults. Correct answer: C. False claims being approved due to bribery or uninformed voting. Explanation: DeFi insurance protocols like Nexus Mutual or Insure Ace often rely on community governance to approve claims. Without strong claim verification mechanisms, such as independent assessors, evidence submission rules, or quorum safeguards, malicious actors can bribe token holders or manipulate votes to approve invalid claims. This leads to capital outflow from the treasury and undermines trust in the protocol's integrity. Well-designed systems enforce stake slashing, KYC, or staking requirements for claim voters to reduce this risk. Question 24. Ms. Beatrice is developing a cross-chain DeFi platform that allows users to lend assets on Ethereum and borrow against them on BNB chain using a blockchain bridge. One morning, a vulnerability is discovered in the bridge's smart contract, exposing user funds. What is the most prudent protocol-level response to mitigate further damage and preserve user trust? A. Increase token emissions to compensate potential losses. B. Migrate all activity to a new chain with fewer dependencies. C. Activate emergency shutdown modules and pause cross-chain transfers. D. Encourage users to self-insure their funds through third-party providers. Correct answer: C. Activate emergency shutdown modules and pause cross-chain transfers. Explanation: in the event of a critical vulnerability, especially involving cross-chain bridges, the correct response is to activate emergency shutdown functions, if coded in the protocol, and pause bridge activity to prevent additional exploits. This buys time for the team to patch vulnerabilities, alert users, and recover or compensate funds if possible. Many mature DeFi protocols include pause mechanisms, multi-sig-controlled emergency responses, and bug bounty alerts to mitigate real-time crises. Responses like increasing emissions or migration may worsen trust without addressing the core risk. Question 25. What is a major drawback of algorithmic stablecoins compared to fiat or crypto-collateralized models? A. They rely on oracles for determining off-chain interest rates. B. They require staking of validator tokens to issue new supply. C. They often lack sufficient reserve backing, leading to reflexive depegging during market stress. D. They depend entirely on centralized custodians for redemptions. Correct answer. C. They often lack sufficient reserve backing, leading to reflexive depegging during market stress. Explanation. Algorithmic stablecoins, e.g., Terra's USD prior to its collapse, use supply-demand algorithms to maintain their peg without full collateral. This creates reflexivity. When confidence drops, users rush to redeem, increasing supply of the paired token, which leads to further sell-offs and depegging spirals. This vulnerability was demonstrated during USD's collapse in 2022. In contrast, fiat-backed, e.g., USDC, and crypto-collateralized, e.g., DAI stablecoins have tangible reserves that help maintain peg stability during volatility. Question 26. In DAO governance systems, which of the following mechanisms best enhances resistance against governance capture by large token holders? A. Vesting governance rights only after assets are transferred. B. Replacing on-chain voting with community sentiment polls. C. Implementing quorum thresholds and vote escrow models, e.g., V-tokenomics. D. Allowing proposals to execute after soft majority, regardless of participation. Correct answer. C. Implementing quorum thresholds and vote escrow models, e.g., V-tokenomics. Explanation. To prevent governance capture, protocols implement quorum rules, requiring a minimum % of token supply to vote, and vote escrow models like VCRV, where longer lock durations give more voting power. This discourages whales from influencing votes solely for short-term gain and incentivizes long-term alignment with the protocol. By contrast, low participation, soft majorities, and off-chain polls are more prone to manipulation and less transparent. Question 27. Mr. Kenji, a developer for a DeFi lending platform, notices unusual liquidation activity on a newly listed asset. After investigation, he finds that the asset's price oracle was misconfigured and fed stale data, triggering unnecessary liquidations. What is the most responsible immediate action for the protocol to take? A. Permanently disable the asset across all pools. B. Initiate a DAO vote to issue governance tokens to affected users. C. Revert affected liquidations and pause the asset until oracle issues are fixed. D. Do nothing, as smart contracts are immutable and the platform is decentralized. Correct answer. C. Revert affected liquidations and pause the asset until oracle issues are fixed. Explanation. While smart contracts are generally immutable, mature DeFi protocols often include pausing and upgrade mechanisms to handle emergencies. In Kenji's case, the platform should pause all interactions with the affected asset, investigate the oracle feed, and reimburse users if wrongful liquidations occurred. If the platform has a governance or admin multisig, they can initiate rollbacks or compensation measures. Ignoring the issue would erode trust, and disabling the asset permanently may be premature. Question 28. Why do DeFi protocols increasingly rely on third-party security audits and bug bounty programs before launching on mainnet? A. To comply with FATF travel rule for financial services. B. To reduce regulatory tax obligations from launch emissions. C. To proactively identify and mitigate smart contract vulnerabilities that could lead to fund loss. D. To enable perpetual rebase events and reward liquidity miners. Correct answer. C. To proactively identify and mitigate smart contract vulnerabilities that could lead to fund loss. Explanation. DeFi protocols are inherently vulnerable due to their open-source nature and immutable smart contracts, Without rigorous audits and bug bounties, they expose users to risks such as reentrancy, overflow, or Oracle manipulation. Well-known firms, e.g., Trail of Bits, OpenZeppelin, CertiK, and platforms like Amunefi, provide valuable services to discover and patch vulnerabilities before malicious actors can exploit them. This is a critical part of DeFi security best practices, especially before handling large user funds on mainnet. Question 29. What is a primary advantage of using liquid staking derivatives, LSDs, such as SynEth or RETH in DeFi protocols? A. They eliminate the need for price discovery in AMMs. B. They allow staked assets to remain liquid and earn yield in secondary protocols. C. They provide insurance against DAO attacks and smart contract bugs. D. They lock tokens in centralized custody to prevent on-chain manipulation. Correct answer. B. They allow staked assets to remain liquid and earn yield in secondary protocols. Explanation. Liquid staking derivatives, LSDs, allow users to stake ETH or other POS assets and receive a tradable token, e.g. SynEth, that represents the staked position. This enables users to earn staking rewards while also using the LSD in DeFi, such as lending on OV or farming on Curve, thereby compounding yield. LSDs have become key to DeFi composability, but they introduce risks related to peg deviation and smart contract exposure. Question 30. Dr. Naveen, a quantitative researcher, is designing a delta-neutral strategy using perpetual futures on a decentralized exchange, DEX, like DYDX. He goes long on ETH in a lending protocol and opens a matching short position in a perpetual contract. However, his position starts showing negative returns. Which factor is most likely eroding his profits despite the market moving sideways? A. Front-running by validators due to low slippage tolerance. B. Flash loan arbitrage, removing collateral from his vault. C. Impermanent loss caused by his derivative position. D. Funding rate payments to short position holders on the perpetual DEX. Correct answer. D. Funding rate payments to short position holders on the perpetual DEX. Explanation. In delta-neutral strategies, traders aim to hedge spot exposure with futures or perpetuals to isolate yield, e.g., from lending. However, perpetual contracts use funding rates to maintain price parity with spot markets. If Dr. Naveen is short and the funding rate is positive, he must pay the funding fee regularly, which can cause losses even when ETH price is stable. This highlights why funding rate monitoring is critical for maintaining profitability in leveraged and hedged DeFi strategies.